Picking up where we left off, what we had found out that in the 6th year, which would be dividend 1 to the investor who would buy the stock from me at the end of the 5th year, we found out that their dividend would be $1.88. But we would expect for that to grow constantly. So in order to execute the formula, we have this $1.88 dividend 1. We now need to divide it by rate minus growth. So let's go ahead and update our formula so that the rate, which in our case is that opportunity cost of capital that they would expect, from which we would subtract off that constant growth. What that suggests and estimates is then at the end of the 5th year, after I, as the investor, have received all of these 5 dividends, I should be able to sell my stock for $26.86. Ultimately, what we're trying to figure out is how much an investor like myself would be willing to pay for a share of stock today. And we know from our TVM history that what we ask is how much would you be willing to pay in total today for future cash flows that can be projected, knowing that I have an opportunity. So for example, in that first year, what we would be willing to pay on a present value basis would be at the rate of 17%, for which I will lock that rate since it's sitting in one place by putting $signs in front of the column and row reference. But that is 17% opportunity cost applied to something that comes one period away, where it's not a payment that I would get, but a single future value of 30 cents, suggests that I would be willing to pay up to 26 cents right now. Now, if I would like, since that may look a little strange, what I can do is put a negative in front of that just to flip the sign, so that in essence, what I'm saying here is I would be willing to pay up to 26 cents today for 30 cents that comes in one period, assuming a rate of 17%. Now, knowing that I set up my formula well, I can copy and paste it across such that in that second to last period for the $1.36 at the constant rate of 17%, I'd be willing to pay 72 cents. But if we take a look here, what we see is the need to change something. Because in that 5th year as an investor, not only would I predict to be able to receive $1.71, but I also would be able to receive that future price that I would sell to a new investor. So if we change up our formula so that the future value that we would get in the last or 5th year would be both the dividend that's in G51 as well as the future price that's sitting in G52, tells me in totality I'd be willing to pay up to $13.33 today. Let me go ahead and clear out these notes since they don't apply across the board. And then as it suggests, now that I have predicted all of my dividends, and I predicted how much I'd be willing to pay for those dividends on a present value basis, and I've projected how much I would get when I sell it in the future, and determined how much I'd be willing to pay for both the dividend and the future price in year 5. If I just sum up those values, then what it suggests is I should be willing to pay up to $15.12 today for a share of Gia's Tortillas, which is expected to give me dividends as indicated in the following cash flow in dividend stream, plus the amount of the future price for which I could sell it at a rate of 17%. I'd be willing to give Gia up to $15.12.